5 years ago, I started investing with absolutely no idea what I was doing. Since then, I've probably tried every single type of investing: actively managed funds, stock picking, factor investing, index trackers. You name it, I've probably done it when it comes to investing. And over that time, I've learned quite a lot. I've made some good decisions, definitely some bad ones, and I've eventually worked out the sort of portfolio that works for me, and I think I've finally cracked long-term investing, for me anyway. My Trading 212 stocks and shares ISA portfolio has just surpassed £50,000. So in this video, I wanted to take the opportunity of the milestone to share what I've learned along the way, share my biggest mistakes, and things I do differently if I could start again knowing everything I know now. Before we jump in, this video is made for informational, educational, and entertainment purposes only. I'm sharing my own journey. I'm not a financial advisor, and this is not investment advice. When investing, your capital is at risk, and past performance doesn't guarantee future results. Please do your own research. So taking a look at the portfolio as it stands now, it's just over £51,000, rate of return 37.8%, total return £7,000. We'll talk more about this rate of return and total return later on in the video because that is actually related to one of the mistakes. And my return is actually higher than this, but again, we'll get onto this later. For me, this £50,000 is a great milestone because it's the first time that it actually feels real, that I'm building wealth over the long term. Of course, I've always been building wealth, but it's just nice to have this nice round number milestone. And it's great to have these checkpoints along the way to financial independence, whatever you're aiming towards. For some people, £50,000 in a stocks and shares ISA in 5 years is not an achievement at all, and they might think that's not impressive. On the other hand, some people might think £50,000 in 5 years is amazing. It completely depends on perspective, and you should always not compare yourself to others. Everyone's circumstances are different. Everyone watching this video will have completely different circumstances, how much they can save, how much they earn. So just celebrate your own victories and optimize what you can do with your situation. Comparison really is the thief of joy. So I've mentioned this is all inside Trading 212's Stocks ISA. So a Stocks and Shares ISA is a type of tax-advantaged account. You can deposit up to £20,000 per tax year into a Stocks and Shares ISA, and all your investment gains, dividends, and interest are not subject to UK tax. Now, importantly, it's just your deposits per tax year that count towards that £20,000 allowance. Gains and dividends don't count towards the allowance, and the allowance resets each tax year. You get another £20,000 you can deposit. Now, that's a very generous allowance. It's not a goal to reach that. That's just what it is. The most important thing is that at the moment, there's no cap on how much a stocks and shares ISA can grow to. The limit is just on deposits per tax year. So it is a great way of building tax-free wealth. Some people call it the UK's wealth cheat code, and you can withdraw at any time. Now, back to my current returns. It says plus £7,000, which may not seem too impressive after 5 years. And that leads us on to the mistake number one. I've switched platforms a number of times since I started. I started investing with my bank. I opened a stocks and shares ISA with them. I did that for a year. I then switched to a higher fee traditional investment platform. I've then used 2 new investment platforms, Trading 212 being one of them, and also Invest Engine. And recently, in the last 6 months or so, I've transferred. So I just have one ISA, Trading 212. In the case of Trading 212, I've had this ISA for about 18 months. You can see I've only got 18 months worth of performance, and the big jump in the chart here on the maximum return, that big jump is where I transferred one of my ISAs. Now my stocks and shares ISA is all in one place, but I do not have that full performance history. So mistake number one is when you start investing, do that initial research to find a platform that suits your needs, you're happy with, it's low fee, and then you'll have your full performance history because it's really great being able to look back and seeing what you've achieved. For me, I now have to use an external portfolio tracker to keep on top of all this performance. And it does make videos like this a bit more difficult because I have to explain why is my return so low. Whilst this may only be a problem if you're a content creator, the bigger thing here is just making sure you pick a low fee platform because high fees are your worst enemy when it comes to investing. The more you pay in fees, the less of your investment returns you get to keep. And every £1 you pay in fees is £1 less in your portfolio to compound over time. And we all know compounding returns is the name of the game when it comes to long-term investing. Now, after doing your research, if you do decide you want to try out Trading 212, you can claim up to £100 in free fractional shares when you sign up via my link in the description or scan the QR code on screen if you're watching on TV. Alternatively, within 10 days of opening your account, you can use my promo code TOM in the menu page of the app. For full transparency, that is an affiliate link and code, so I do get something too if you do use it. I've been using Trading 212 since before I was an affiliate partner with them, and I really do think it is one of the most competitive platforms when it comes to fees, UI, investment range. It just does everything so well, and for me, it is the one that won out. I've merged all my portfolios together, stocks and shares ISA portfolios together on Trading 212 and have it in one play. Now, this next lesson is arguably the most important, and you're probably not going to like hearing it. Long-term investing is boring. I'm not going to sit here and BS you and say that I've made some incredible returns. The reality is, when you first start investing, your contributions are going to do the heavy lifting. Just think of it like this. If you deposit £1,000, you have a £1,000 portfolio. Even if the stock market goes up by 10% in that year, for example, you're only going to have made £100. But if you're depositing, say, £200 per month, what's more important, your £200 per month deposits or the £100 in gains? Whereas on the other hand, say you have a 100k portfolio, it goes up by 10% in a year, you've made £10,000 in returns, whereas your £200 deposits are comparatively much less important, still important, but you get the idea. Long-term investing is boring, and when you're starting from scratch, it's about building that consistent habit, depositing, not expecting it to be a get-rich-quick scheme. It's a build wealth over the long-term scheme. And a lot of people get this wrong. They get too excited, see people making huge gains on individual stocks, and whilst, yes, that is technically possible, for most people, you don't want to take on that extreme level of risk with chasing those very high returns. Very high returns come from taking very high levels of risk. For me, it's all about balance. And as an example of what I've experienced in my journey, from about late 2021 to late 2023, the global stock market basically didn't move. Of course, it moved along the way, but that deposit in 2021 into a global index tracking fund would have been pretty much the same in value nearly 2 years later. And that's to be expected. It's not always going to be periods of incredible gains like we've seen over the past 2 years. And some years, it will go down a lot. That's the reality of investing. It's a long-term game. There's volatility, there's drawdowns, there's crashes, there's dips. It's never going to be a straight line upwards, and you're not going to get rich quick. So yeah, long-term investing is boring. It's incredibly powerful, but just don't get sucked into the idea it's some get-rich-quick scheme, and next year you can be driving around in Dubai in your Ferrari. Okay, lesson 3. This is kind of linked to the last point, but just in more detail, chasing past performance and FOMO investing. When you first start investing, you'll see on social media people showing off incredible gains on huge stocks, or you'll browse through actively managed funds, and on some websites you'll be able to see the fund and then the past performance, and you'll be able to sort by past performance, and you'll go, oh, these active managers have achieved incredible returns, so why don't I just go with them? They clearly know what they're doing. Well, the truth is, with active managers, just because they've done well previously does not mean they'll go on to deliver those incredible results. There's research that you can look into that shows that most active managers over the long term do tend to underperform their index benchmarks, and that's mainly due to the skewness in stock market returns. A small percentage of the stocks deliver the majority of the gains, so if they miss out on this small percentage of stocks, their returns are going to suffer. And they're building more concentrated portfolios in an attempt to outperform the market. And by building those concentrated portfolios, there's a chance they're going to miss out on those key winners. And with individual stock picking, yes, you will see some people achieving those incredible returns due to the skewness in stock market returns. A small percentage of stocks deliver incredible returns. So if you're lucky enough to have a super concentrated portfolio and have one of those incredible performers, yes, you're going to have those screenshot-worthy portfolios plus 500% in 1 year, whatever it may be. But we have to be honest about the risks. The vast majority of stocks aren't like this, and you do risk catastrophic losses when it comes to individual stocks. So just be careful if you're FOMO investing, chasing past performers. You are taking on more risk with concentrated portfolios. If you're happy with that risk, then fair enough. But for me, I just prefer sensible diversification and letting the stock market do its thing over the long term. Now on to lesson 4, overcomplicating my portfolio. Again, we've touched on it. But overcomplication means your portfolio is much harder to manage. I've gone through all this. I've had actively managed funds, individual stocks, factor funds, whatever it may be. And yes, there's no harm in trying out all these strategies if you want to, but it's really hard to keep on top of. You end up doubting yourself, questioning each position of your portfolio. It requires more maintenance, but also you can't switch off. When you have all these things in your portfolio, you're constantly thinking about if you've made the right decision, if you should sell something, if you should buy something. And instead, what I've done, what I've learned, is that the combination that works for me is the core and satellite approach. This combines having an interest in investing, but with also keeping things sensible and easy to stick to. So the easiest way to explain the core and satellite portfolio is that in the core, I just have a simple global index tracking fund that contains thousands of stocks and delivers the return of the global stock market. Not trying to beat the market, nothing fancy, it just tracks the return of the global stock market. I don't touch this part of the portfolio, I just let it do its thing and regularly contribute to it. It makes up about 70% of my total portfolio. Then, with the other 30% are the satellite positions. This is where I can put my own spin on things, try out those actively managed funds, try out complex strategies like factor investing, small cap value, or maybe for you it might be individual stocks. With individual stocks, they are of course riskier than diversified fund options. For me, they make up about 5% of my portfolio. But my point is here, the clear separation between the sensible global core and then the satellite funds as well. If I wanted a truly hands-off approach, if I had no interest in investing and I was just doing it to build wealth, I wouldn't even bother with the satellites in my situation. But for me, because I have an interest in investing, I've gone with the compromise, core and satellite. I've cracked that behavioral side of investing, no longer doubting myself, allow myself to experiment, but have that sensible global core to fall back on. Now, this is not investment advice. I'm just showing what worked for me. But for me, this really helped me crack the behavioral side of investing. I enjoy investing. I can experiment with those satellites, but also I can switch off and not think about my portfolio all the time. Okay, and the last lesson, time in the market beats timing the market. If you're an experienced investor, you're probably sick of hearing this phrase because it is said a lot, but it just is so true. No one can predict what the stock market is going to do. Just look at this year, for example. We had the Trump tariff dip back in April, and you should have seen the state of my comment section back then. A lot of people tell me this time is different. It's going to take 10 years to recover. Trump's done it. The stock market is in chaos. The global economy is going to come crashing down. And just look where we are now, 6 months later. The stock market has had one of the best starts to a tax year I think it's ever had. I can't recall or think of a time where the UK tax year starts on the 6th of April, perfectly coincided with the dip, and then just flown ever since. So anyone who started investing this tax year has had an incredible return. But if they'd have listened to the scaremongers back then, they would have missed out. It does work both ways. The stock market could crash tomorrow. It could keep on soaring for another year. I have no idea. But the thing is, that's the key point. I have no idea. So as a regular retail investor, long-term investor, I just regularly deposit regardless what the market is doing. And I trust that hopefully over the long term, the stock market will deliver me decent returns. I accept there'll be volatility. I expect there'll be periods where returns look boring. Like the example I referred to earlier on, 2021 to 2023, not much happened. But for me, it links to that behavioral side of investing we've referred to, accepting that I don't have the secret. I don't know something that no one else does. And I'm really skeptical of people who make these projections about the market because how can they possibly know what's going to happen? You might hear the phrase buy the dip. So when the stock market goes down, people want to buy the dip. But they do this after like a 1 or 2% decline. And that dip could become a crash. And then if you've deployed all your spare cash, your emergency fund to buy that 1% dip, and then it ends up going down by 20%, you're going to be feeling really bad about it. But instead, I just prefer regular contributions, depositing regardless of what is happening. And that way it removes that behavioral element from it. I'm not trying to be smart, trying to predict what's going to happen. So those are 5 things I've learned on my journey building a 50k stocks and shares ISA portfolio. I don't claim to be the most experienced investor here or that I'm going to have incredible returns. For me, I just want consistency and hopefully build wealth over the long term. And I've cracked what works for me. That behavioral side of investing, I underestimated for so long and thought it was worth chasing higher returns. At the end of the day, most people just want to be able to switch off, have their portfolio working away in the background. And that's why all these lessons, I think, are worth it for people who are new to investing and want to just get it cracked from the start, because it is very stressful being a new investor, learning all the terms, seeing people showing off their portfolios, and just feeling like you're behind or you're missing out on something. If you enjoy this sort of content, be sure to like and follow for more. Thank you for watching.